tax administration or advancements like digital platforms, artificial intelligence has to be given equal importance, as we cannot neglect them. So let us, through this panel discussion, gain a deeper understanding of these contemporary issues and consider the potential pathways for creative, more equitable and efficient tax system.
And dear friends, today we have with us CA Rekha Umashiva, CA Padamchand Khincha, CA Abhishek Goenka, CA Shankar, the giants of taxation, and the moderator CA Naveen Khariwal. Now I request CA G Ravindra Reddy, chairman of request CA Rekha Umashiv, regional council member, to invite all the fellow panelists on the dais. We have CA Padamchand Khincha, CA Abhishek Goenka, CA A. Shankar, and the moderator CA Naveen Khariwal.
Shri Padamchand Khincha has 40 years of experience in corporate and international tax regime. He is a prolific writer on various topics in income tax. He is a co-author in revising the 13th edition of Commentary on Income Tax by Sampath Iyengar, and has authored various books on complicated, sensitive topics in income tax and also the burning issues. He has delivered more than 500 lectures across the nation on several income tax issues. He's been actively engaged in several initiatives by ICAI. He was appointed as a group leader for preparing the approach paper on guidance note on transfer pricing, one of the most complicated topic even today. He was instrumental in making a critical analysis of direct tax code as a member of the team constituted by ICAI on the request of CBDT. He was a member of the committee of ICAI involving in preparing the technical background paper on ICDS. He was a member in the Rangachari committee to setting up to review the taxation of development centers and IT sector and various other initiatives of ICAI. His teaching stints in the past include guest lectures in IIM Bangalore, intensive coaching classes of ICAI, faculty at DTRTI of the Income Tax Department. He is a commerce graduate from university, 5th rank holder and bachelor's degree in law and qualified chartered accountant with 25th rank, and the most look forward to personality for any income tax issues. We are honored by your presence, sir. Thank you for being with us.
We have with us Abhishek Goenka, decades of experience as a partner at leading firms with a demonstrated history of working in the sphere of taxation. Abhishek is skilled in financial structuring, international tax, corporate finance and M&A. He has also assisted promoters of some of the largest listed companies in Bangalore in moving to a trust holding structure, including dealing with cross-border issues. Abhishek is well versed with the various operating models of single and multiple family offices. Abhishek is also known for his domain expertise in real estate and PropTech. Welcome to you, sir.
We also have with us CA Shankar, a renowned advocate by profession, practicing for over 20 years in High Court of Karnataka and Supreme Court of India. He was designated as a senior advocate by the High Court of Karnataka in November 2018. And before donning the advocate robes, he was practicing as a CA for 20 years. He's an expert in search and survey matters and real estate transactions, and also a generous philanthropist, a reservoir of knowledge which he actively passes on to his juniors. A highly respected individual in society for his affable manners and Shakespearean quotes. A warm welcome to you too, sir.
CA Naveen Khariwal hails from a family of chartered accountants, is passionate for the subject of income tax and related topics, and has associated with ICAI and various other organizations in knowledge-sharing initiatives. Has contributed as part of team of Justice R.V. Ishwar Committee for Simplification of Taxation. He is addressed in various seminars on contemporary topics in 50 branches of ICAI all over India, covering NIRC, WIRC, SIRC, EARC and CIRC, all 5 regions and various study circles as well. A passionate cricketer and pursuing his cricket passion even today as a team captain and winning a lot of matches. Happy to have you with us, sir. Ladies and gentlemen, a big round of applause.
Now I request CA G. Ravindra Reddy, the chairman of Tirupati branch, to hand over the floral bouquet to CA Padamchand Khincha. We have CA Shantil Kumar C, the chairman of Tirupur branch, to hand over the bouquet to CA Abhishek Goenka. And CA Nitta Ravi Kishore, chairman of Vijayawada branch, to give a bouquet of CA A. Shankar.
Ladies and gentlemen, a big round of applause, please.
And I also request G. Ravindra Reddy, chairman of Tirupati branch, to hand over the bouquet to CA Naveen Khariwal.
A warm welcome to all the panelists and the moderator. I request CA Rekha Umashiv, Regional Council member, to give the opening remarks on the topic Contemporary Issues in Income Tax.
We request CA Rekha Umashiv, Regional Council member, to give her opening remarks for the session, Contemporary Issues in Income Tax. We request CA Pannaraj, immediate past chairman of SIRC of ICAI, on the dais, please.
A very good morning to one and all. So very happy to see such a great gathering on the second day of our conference, Jignasa. So it is a great privilege for me to be sharing the dais with such honorary speakers. I would like to invite CAC Padamchand Khincha sir, CA Abhishek Goenka, CA Shankar sir, Naveen Khariwal onto the dais, and also for the wonderful contribution to our fraternity. So today we have a topic which is called as contemporary issues in taxation. So this is one of the issues that has been bothering our economy for a long time. When we see the direct tax base, it is quite small compared to the indirect tax base that is large. Also with the introduction of 43B for the MSMEs and the payments, delayed payments the MSMEs gets, that taxation has come to a point where we require a lot of clarifications and circulars on a daily basis. So today we have three exemplary speakers who can actually take us through various pain points in the direct taxation systems and also explain to you how it could be improved by the futures, and also few other suggestions from their part. Once again, I take this opportunity to invite you, sir.
Over to the panel.
Good morning to all the members assembled here. Due to paucity of time, I am straight away jumping to the question. First question will be to the Senior Advocate of Karnataka High Court. The issue will relate to section 45(5)(a). Now, as you know, this is a recent amendment from 1718 onwards, and the matter has not yet reached even the tribunal. And yesterday night, I happened to go to Shankar sir's office. He gave me an appointment yesterday evening. And for the 10 lines, ladies and gentlemen, for the 10 lines of that section, I had to walk, for 6 kilometers. And multiple interpretations were forthcoming from this genius. All around Malleshwaram, around his office, we walked for around 6 kilometers, even without my knowledge. At the end, he showed me this iPhone. Without your knowledge, how many kilometers you have walked karke. And 6 kilometers, along with that, several multiple interpretations. I was just observing how, the genius, every line, every word, full stop, comma, interpretation. So, without much ado, I would just introduce to 45(5)(a) and then let him take over the issues. As you know, my dear friends, 45(5)(a) is applicable only to individual or HUF, and then it applies to the receipt of land or building, which is only constructed area, in the year of receipt of completion certificate. Then capital gain would be taxed. And then there is a proviso which says that if you were to sell your share of land or building even before the receipt of CC, provisions of 45(1) would apply. So this is a simple, introduction of the subject. So I would request Shankar sir to dwell upon the issues under 45(5)(a).
Very good morning to ladies and gentlemen. We have the pleasure of having two ladies as chairman and vice chairman of our branch. I recall my education from my aunt way when I was a child. She has taught me two lines which are very important, which rings in my mind even today. She said, Yatra naryastu pujyante, tatra ramante devata. Where women are respected and revered, there lives God. So thanks to both of them. Wish them great future ahead in the profession. I stand before you all as a humble student of my mentor, Sarvasri Suresh Venkateshan, who has been a pillar of strength, philosopher, guide, mentor, and whatever it can be attributed to. And my respects to him. Before I dwell upon the subject which is eagerly awaited. Before I dwell on the subject directly, it's very important to state some concepts about the Income Tax Act. Income Tax Act is a great battle between the government who wants to collect tax and the taxpayer who wants to legally avoid tax. This is the fundamental ethos of all practice. This is the fundamental ethos with which budgets are made year after year. And if any one of you all have counted the number of amendments to the budget from 1961 till today, I am sure it will cross more than 5,000. That shows one great quality of the fraternity we are. The chartered accountants are brilliant in interpreting the sections that the government and the IAS officers keep amending. We find ways to convince the court of law that what the intent of Parliament in the various sections are different from what probably the drafters of the section made. That is the beauty of the law. That is the beauty of the concept of interpretation. I had not had an occasion for a long time to read this section, though this section came into the statute book more than 6-7 years back. I've always felt from my first reading of this section way back a few years that it has misfired its objects. It has not achieved the objects for which it came into existence. Has it achieved what it wanted to, or has it created more confusion for the tax collectors, taxpayers, and tax advisors? I am not able to come to definite conclusion on the various questions which I have put to myself in respect of this section. In order to give you all a little bird's eye view on this question is actually a one-day topic, according to me, as it goes right from probably the time what transfer is and flowing to what price bargained for, decided by the Supreme Court in the case of George Henderson, somewhere in 50-60 ITR, to the present day number of ITRs, 450 plus. There is an evolution on the concept of capital gains. I will read this section in one way with small pauses to give you all certain insights of the possible error of judgment by the drafters in achieving what they desired to achieve and what they have ultimately achieved. I will read only section 5A. It reads as follows: notwithstanding anything contained in subsection 1. Subsection 1 is the charging section of capital gains. There is nothing deeming in it. It is a plain section. Where the capital gain arises to an assessee, being an individual or a Hindu-ended family. The first shackle in the section is, this section is applicable only to an individual or a Hindu-ended family and does not encompass on other entities or other persons defined under section 231 of the Income Tax Act. It is restricted to individual and HUF. From the transfer of a capital asset, the language used is transfer of a capital asset, being land or building or both under a specified agreement. These are very, very important words in interpretation. To emphasize, transfer of a capital asset, being land or building or both, under a specified agreement. Now, what is a specified agreement? In explanation, they have said, specified agreement means registered agreement in which a person owning land or building or both agrees to allow another person to develop a real estate project on such land or building or both in consideration of a share being land or building or both in such project, whether with or without payment or part of the consideration in cash. I have not been able to understand this after reading several times. What is this specified agreement? That means if there is a transfer in terms of the Income Tax Act for a specified agreement, that means under a specified agreement, it indicates an inference for a articulative argument to put to the department saying that first there must be a transfer within the meaning of the act, and it should be under a specified agreement. If a transfer takes place under a specified agreement, if a transfer within the meaning of Income Tax Act takes place under a specified agreement, then this section springs up. If a transfer does not take place under the specified agreement under the Income Tax Act, in my respectful submissions, with all humility at my command, my view is that this section does not apply. This section applies only when there is a transfer and under a specified agreement. The general notion is, once there is a development agreement, 45(5)(a) will spring up. To my surprise, even after 6 years, I have not come across any great jurisprudence or judicial dictum on this subject. So the womb of future is very uncertain of how the interpretation of this section will take place in course of time. Or is it time for the lawmakers to make some changes? Back to the section. The primary core aspect of 45(5)(a) is that there must be a transfer under a specified agreement. So now once this is the primary condition, we have to go back to the specified agreement and find out whether there is transfer or not. If there is no transfer, this section is out of the system. If there is transfer, then you need to read the second part. Whether there is transfer or not depends upon the language of the specified agreement, whether the specified agreement could fit in within the meaning of section 247 of the Income Tax Act for the purpose of definition of transfer. If it does not fit in, if the clauses in the agreement do not indicate that you will fall in one of the 6 limbs of 247 of the Income Tax Act, 2 subsection 47 definition, then only this section applies. The object with which this section came is basically because of one of the decisions of the Karnataka High Court called Dayalu. What had happened there was the interpretation of the agreement, which is now called the specified agreement. The revenue took a contention that you are falling foul of, or you fall within the parameters of subclause 5 and 6 of the definition. Once you fall within the definition of transfer, the expectation of the revenue is you pay tax on the date of entering into the agreement, and consequently, a lot of individuals and Hindu undivided families who are giving their ancestral and other properties for development to monetize their asset found themselves in difficult situation that without getting any money, in anticipation of something that will come to them after a few years, they were compelled to make payment of tax on the day, which was very, very difficult. And this has gone on for the last probably 20 years on the same lines. Government in its wisdom thought that they want to give them some mercy, they want to give them some concession, and consequently this section was brought in. They said, you need not pay tax on the date of the agreement, but we will tax you on the subsequent event. I will read the second part of section 45(5)(a), which will clarify this aspect of the matter. Under specific, the capital gain shall be chargeable to income tax as income of the previous year in which the certificate of completion for the whole or part of the project is issued by the competent authority. Now they are saying, I'll divide into 3 parts. The second part is, the capital gain shall be chargeable to income tax as income of the previous year in which the certificate of completion for the whole or part of the project is issued by the competent authority. Competent authority has been defined. Now they say, there is a transfer as per the agreement, so please don't pay tax on that day. It gets postponed to a another date. What is that another date? That is the date of completion certificate issued by the competent authority. Now, there are several, this drafting is based upon the knowledge of some of the senior law officers of the country living in different states in the country. Different states have different way of addressing the land laws. In Karnataka, there is nothing called completion certificate at all. You will never get a completion certificate under the Karnataka Municipalities Act or the Bangalore Corporation Act or the Brihat Mahanagara Palike. In all this, there is no completion certificate. What we have is what is known as an occupancy certificate. But occupancy certificate is not mentioned. And the drafters have not said completion certificate, occupation certificate or anything in the like matter by whatever name called. In several sections under the Income Tax Act where there are broad parameters, they have said by whatever name called. Here they have not said so. So you have to look at only completion certificate. Suppose the completion certificate is not given by the competent authority at all, does it mean that there is no capital gains at all? There is a transaction, there is a event, your land, the owner's land has been given to the developer, he has completed the project or nearing completion, but there is no completion certificate expected from any competent authority because the authority which sanctions the plan does not give a completion certificate but an occupancy certificate. This will be another one area of litigation. And second aspect of it, which probably we also have to emphasize, is completion for the whole or part of the project is issued by the competent authority. This is a very draconian provision. You wanted to give a benefit, but on the other hand, you have literally taken away a benefit which was otherwise available by interpretation. What they say is whole or part of the project. What is this whole or part? Today's development on certain areas, small developments of a small site in a city where a small parcel of 5,000, 6,000 land built into 10, 12 flats is one level. But then when the city is expanding and there are developments happening in large acres of land where they do by several blocks, there are several towers coming up in each project, whole or part. What is whole or part? Suppose you have got the occupancy or completion or whatever certificate name called for one of the buildings in the entire project, does it mean that the entire project taxation has to be calculated? They have not said only in relation to what you have got occupancy. Whole or part of the project completion certificate is given, the liability to capital gain springs up, and then this is another area which is going to get into large litigation because we will be in the same position as we were earlier. We did not have the money, but we had to pay the tax. Even now, the interpretation made by an officer can be said, oh, you got for a part of the project. So the second limb springs up. Once the second limb springs up, please compute capital gains for the entire thing. Now I'll go to the third limb. And for the purpose of section 48, the stamp duty value on the date of issue of the said certificate of his share being land or building or both in the project as increased by the consideration received in cash shall be deemed to be the full value of consideration received or accruing as a result of transfer of the capital asset. I don't know what to say. Is it draconian? What exactly they mean? Half a dozen interpretations can be given. We all have to understand 45(1) deals with capital gains. It is any profit and gains arising of a transfer of a capital asset. And what is the consideration? Consideration defined under section 48. Supreme Court way back in George Henderson and Gillander Albernot has clearly said consideration means the price bargained for between the parties. What is the price you bargain with the person? That is precisely the consideration. That is what the settled position of law. Then taxpayers had some very great intelligence in themselves. Bangalore is the originator of this amendment. I am aware of the background. Way back in 80s, there were buildings and flats coming up, possession given, registration not made, no tax paid on more than 600, 700 flats. Money is lying as only advance from customers and work in progress in the balance sheet. And they brought in the definition of 247 and the amendment to section 245 of the Income Tax Act. What they brought in? They said you have to pay tax. They removed the second limb of 45(1) to say what shall be the consideration and brought some deeming sections under 45.2, 45.3, 45.4 and now 45.5a over a period of time evolved. Each one of them are deeming consideration. So all of you all want to understand the difference between the price bargained for and the deemed consideration in the different limb. 45.1 talks about specific consideration. The remaining all are expecting some value to be the deemed consideration. Thus, there is a marked difference between 45.1, 2, 3, 4, 5a, etc. Please read the decision of the Bombay High Court in Techspin Engineering. I don't remember the citation. I will pass it on if I recollect. Very well articulated judgment. The difference between the last few words of 45.1 and the last two lines of the remaining section, what exactly is consideration. Now coming to 45A, they are put a condition by saying that his share being land or building or both in the project. Somewhere now the word project has come. I gave him a land, I wanted to get back some flats. Now project. In the project means, does it mean that I have to pay tax in relation to the land which I am retaining also? Land and building of my share in the project will be considered as the consideration for transferring some land to the developer. I'll give a simple example which probably will put little better thoughts in your mind. Let us take an example of a simple development agreement. I never use the word joint development, which has its different connotations. A development agreement, land is 10,000 square feet, capable building is 20,000 square feet. 50-50 is the arrangement. That means out of the 10,000 square feet of land, I will retain 5,000 square feet and give 5,000 square feet to the developer. In turn, what do I get it? He builds 20,000 square feet of built. He retains 10,000 and gives me 10,000 square feet of building. So effectively, I will have 5,000 undivided interest in land and 10,000 square feet of building, maybe 5 apartments for convenience. Similarly, he will have 5,000 square feet of undivided and 10,000 square feet of building. Now, how do you compute 45A in one reading, which one of the department people have interpreted and the matter is in appeal? He is saying the consideration for giving his 5,000 should be the value of your 5,000 square feet of land plus the building. We were earlier saying what we got in exchange is only built area. So we will, whatever the value of building I got, I may not sell my share at all. I just want to keep it. But why do I have to pay taxes on the value of land and building which I am retaining as the consideration for the land which I am parting? This is precisely one of the interpretation possible, and it's already been tested by the revenue, and there are appeals pending which we are handling independently. Now, this and they are fortified by a corresponding amendment to section 49. What they are saying is whatever is decided as consideration here for the purpose of 45(5)(a) will be deemed to be the cost when you sell. The question is, if I am going to value 10,000 square feet of built area in my example, I will say 3,000 rupees is probably the cost of construction, reasonable. Stamp duty value, all that become a part later. It is 10,000 into 3,000 rupees, that is 3 crores is what will be the value. But department says no, see the interpretation. Value of the land, building are both in the project. My share, what is my share in the project? My share is 5,000 square feet of land plus 10,000 square feet of building. That is called an apartment in the common parlance. What the revenue is trying to do is, this 10,000 square feet is precisely valued at 10,000 rupees a square feet as apartment and want to tax me at 10 crores of rupees as against 3 crores. Now, as far as this is concerned, I know, lead to a lot of litigation. We should not blame the government because they are giving us opportunity to interpret, giving us all work. So we all have to say, Annadata Sukhi Bhava. I allow my panelists to ask the next question as messages come. As this subject is so dear to me, I can go on and on for probably the whole day on various aspects of the joint development agreements, right from possession, etc., which an appropriate time comes, I will elucidate in a much better manner. In a nutshell, if I have to conclude this proposal, 3 things are essential. The very object of bringing 45(5)(a) has misfired. It is the duty of the CA Institute to write to the government to make this more feasible for small landowners. Last but not the least, it is going to give a golden opportunity of work for all the fraternity. Thank you.
Sir, moving on to the next question to Padam sir. Now more than 35 branches, out of the 45 branches, they asked me to raise this question because now it is the season of tax audit. So regarding 43B clause H, how to tackle this section, how to interpret this section, what about a disclosure as per section 22 of the Act? Over to you, sir.
The question is on interplay between 43B subclause H, which begins with a non-obstante clause. 43B itself has a non-obstante clause, which says notwithstanding anything contained to the contrary under the provisions dealing with computation of business income, what is payable to an MSME if the time available to the SSC under section 15 of the MSME Act has expired, then he will not be allowed that deduction on the accrual basis of accounting. He will be given a deduction in the year in which the actual sum is paid to the MSME. 43B therefore begins with a non-obstante clause. Now here is a case where I am opting for being governed by the presumptive taxation regime, let us say 44AD or 44ADA, which also says notwithstanding anything contained to the contrary under 28 to 43C. So apparently there appears to be a clash between 43B and 44AD or 44ADA. The problem gets compounded when you go to section 23 of the MSME Act, which says that notwithstanding anything contained to the contrary in any other law for the time being in force, interest paid to the MSME concerns will not be allowed to you as a deduction. And therefore the problem arises because of the clash between non-obstante clause, particularly between 43B and 44AD. To appreciate this controversy, we go back to section 28, which talks about income under the head profits and gains of business in relation to a business being carried on by an SSC. Section 29 says you shall be allowed this income computation on the basis of the provisions of 29 to 43D. So you go on applying these provisions for the purpose of computation. Apply 30 to 38. You will have all allowable deductions. And interestingly thereafter, apply section 40. We said notwithstanding anything contained to the contrary under section 30 to 38. So there's a non-obstante clause there. Go further, 40 capital A, payments to relative, payments in cash, which says notwithstanding anything contained to the contrary in any other provision dealing with computation of business income, this will not be allowed to you as a deduction. Go to 43 capital A, which says foreign exchange fluctuations. Notwithstanding anything contained to the contrary under the law, foreign exchange fluctuations shall be allowed in a particular manner. Therefore, we have many non-obstante clause within the computation provisions. What we have to appreciate, therefore, is that there are provisions dealing with computation of business income, allowing you to go through section 30 to 38, and thereafter there are certain restrictions saying that the following deductions shall not be available to you in computing the income under the head profits and gains of business. Therefore, if it is not done tedious, not allowed as a deduction, if you have not made payments to in cash or in check, then you will not be allowed a deduction because of 40A3. So these are all sections concerned that put a restriction on the quantum of deduction available to an SSC while arriving at the business income. Therefore, when you have these provisions in mind, one set of provisions, and then go after, the government has said, hey, I am providing you for a regime of computation provisions between 28, apply 40 capital A, 43 capital A. I am therefore also going to give you a parallel regime of computation for residents, beginning with 44 AD, ADA, AE, AF, for non-residents under 44B, 44BB, 44BBA, 44BBB, 44BBC. Now, these are all presumptive taxations, both for residents as also non-residents, where they are making a clear statement that X percentage of your revenue shall be deemed to be the income under the head profits and gains of business. That means the last figure that is arrived at by virtue of a computation provision is now fictionally provided for in all of these sections concerned, beginning with 44 AD up to 44 BBC, that is a new section introduced by the Finance Act 2024. So they give you an alternate mechanism, and these sections very clearly say, notwithstanding anything to the contrary contained in 28 to 43C. This is the general section, this is the general terminology. We'll come and notice to some certain exceptions to this terminology, which makes it an interesting reading. But what I'm trying to drive at by this process concerned is that you are coming to the end figure of the computation of profits and gains of business by applying these presumptive taxation sections. So what you do by journeying through sections 30 to 38, 40, 40 capital A, 43B, you are now coming to the same result by virtue of section 44AD onwards. Therefore, these sections say, notwithstanding anything contained to 28 to 43C, you shall have X percentage of the turnover or gross receipts as income. This shall be in substitution of the entire computation mechanism that you are applying through and by going through the provisions of section 30 to 38 and 40 and 43B also. So therefore, on a conspectus reading of the purposes being served by these two bunches of provisions concerned, we come to a conclusion that if you are opting for 44 AD, then the amount of income arrived at, or 44 AD or the like sections concerned, the amount arrived at by virtue of the computation or the presumptive taxation shall be in substitution of, shall be in replacement of, and this will have a more powerful application than the provisions contained in section 30 to 38 for the reason that 43B, for example, was introduced into the Act by the Finance Act 84. Finance Act 83 with effect from 1/4/84 onwards. So when 44 AD was brought into the statute, 44 AD was brought in the statute book, the Parliament was aware of the existence of these sections concerned. Nevertheless, it said, hey, I'm not going to provide for an exception there. I'm going to make a statutory fiction being created now, saying that X percentage of the turnover or gross receipts shall be your income concern. When you go back to certain provisions of this presumptive taxation, it gives rise to very interesting reading. For example, if you were to go back to 44 AE, it says X percentage of the turnover shall be your income, and I shall allow you further interest to partners and salary to working partners as a deduction. So they are saying, I'm going to give you this separately as a deduction. If you go to 44D and 44BBA, it says, notwithstanding anything contained between 28 to 43 capital A. Very interesting. Notwithstanding anything contained between 28 to 43A. That means they are saying 43B will apply in those sections dealing with 44BBA type of incomes or 44D type of incomes concerned. Therefore, we will start making a comparison of the language concerned. We have very clear differences in the language in the presumptive taxation also. Somewhere they are very clearly saying 43B will continue to apply in particular situations concerned, and in other situations where there is a silence in terms of the law to say, I'm going to override anything between 28 to 43C in the course of application or in the course of arriving at the income from business concerned, then in my opinion, the presumptive taxation regime shall prevail over the computation mechanism, which includes 43B also. That will be my opinion, although I am aware of the Panji bench decision which is against the SSC in the case of Good Luck Kinetic, which is against the SSC, but they have not gone through the entire process of reasoning of the law concerned. There is a favorable decision in Krishna Kumar Agarwal's case of the tribunal itself saying that, hey, when you apply this presumptive taxation, they shall prevail over the normal computation provision, they shall prevail over 43B also. In my opinion, that represents the correct law. Thank you.
Thank you, sir. My third question would be to my next member on the panel, Abhishek Goenka. For your information, you know, he's practicing in M&A and top 3 M&A firms in India today. In fact, in 2021 real estate deal, when it happened between Brookfields and RMZ, that was the largest real estate deal. And it was authored by none other than Abhishek Goenka. My question for Abhishek Goenka would be 2 questions at one go because of paucity of time. Number one is, you know, the the demand of the industry has been met in this budget, namely angel tax has been abolished. So, sir, how do you see the pending litigations in agent tax, which was introduced by the government way back in 2012? Second question I would like to ask him is, in case a non-resident is selling a property in India, what about the TDS aspect, whether it is on the gross consideration or it should be on the capital gain? Over to you, sir.
Thank you, Naveen. Good morning, ladies and gentlemen. It's an absolute pleasure to be here. I'll start with the angel tax provisions, and as Shankar sir talked about 45(5)(a), saying that the objectives of the section and the language of the section are poles apart. I think the provisions of section 56(2)(7)(b), which is colloquially known as angel tax, is also, in my opinion, one such section. In fact, in my view, it should not be called angel tax because it was actually introduced way back in 2012 to go after some demons and devils which arose out of the 2G scam, which we all have forgotten, and many young CAs may not be aware of what that scam was. What was angel tax and why was it called angel tax? Because it started affecting the startups, and because of all the furor raised by many of the startup investors, the angel investors who have a lot of say in the social media and other channels, it got rechristened as angel tax. I know the question is about what does it mean for pending litigation, but I just wanted to spend a few minutes on some other impact of this. What is angel tax? I'll continue to use that word since that is what is there in the question also. It basically says that if you are buying shares in a company, obviously as a shareholder or as an investor, you see a certain value in the company. Based on that value, and of course you are the best perceiver of what that value is, you pay a certain price per share. Now this I'm talking about a primary investment. If I'm buying shares from another seller, this section does not apply. However, if I subscribe to shares in a company by way of a primary investment, whether by way of a preferential allotment, let's say under the Companies Act, I have a certain perception of the price, I pay that price. What the section said until its abolition by the budget was that if what you pay is greater than the fair value as determined as per the Act, read with the relevant rules, then that surplus will become income for the company. Right? So what under the principles of the Income Tax Act was always a capital receipt. What a company raises from a shareholder by way of subscription for shares, first principles of Income Tax Act is a capital receipt. It does not partake the character of any income, but because of the fiction created by section 56(2)(7)(b, to the extent of the excess paid by the subscriber over the fair value, that is what was being sought to be taxed in the hands of the company receiving the money as income from other sources. Now that is what has been abolished. I think it is a very important aspect because this provision was coming in the way of a large number of transactions where there could have been a difference in the price between two parties coming into the same company at the same time. Now there are two aspects on pending litigation that I wanted to highlight. The section has not been abolished retrospectively. So as per the strict reading, all pending litigations will have to continue and find their normal end through the process of law. Of course, there are several precedents where similar sections were abolished and the government has given guidance to the officers to deal with the litigation in certain prescribed ways. But in my opinion, this matter, like I said, does not limit itself to the startup world. It is only those cases that have made more noise. There are large crores and hundreds and thousands at dispute in the non-startup world. So I will find it very difficult for the government to give a carte blanche guidance to its officers to drop all pending proceedings relating to this section. But to take 2 or 3 specific situations, in many startups also, which being in Bangalore, I'm sure all of you will be familiar with, many startups had taken the startup registration and claimed an exemption from the applicability of this provision. Now, one of the unique aspects of the startup registration is that if any condition which is required for that registration is breached subsequently, the registration is deemed to be withdrawn from the date on which it was granted. And one of the most troublesome conditions is that the startup cannot make any investments in any kind of mutual funds, or it cannot have any subsidiary. And in many situations, startups without full knowledge, they have surplus money, they invest in mutual funds, or for certain genuine business needs, they need to create a subsidiary, and they end up breaching that provision of the registration. Now, if, let's say today somebody breaches that condition, the exemption is withdrawn retrospectively, which means whatever exemption was claimed under the startup tax, angel tax provisions, i.e. 5627B, will apply in that year in which it was claimed. And the abolition of that section with effect from April 1, 24, in my opinion, will not give you any relief for the mischief that will get created because of the surrendering of the startup certificate. The other quick point I wanted to make on this is in relation to the potential GST angle that comes in. Now let us take a very simple situation where two parties want to create a joint venture, right? One party says, I will bring capital of 100 rupees into the joint venture for 50% stake. The other party says, I will provide services worth 100 rupees for my 50% stake. With the abolition of angel tax, what one can do is say, the person who is providing the service will subscribe to their shares at 1 rupee, and the person who has to bring the capital will subscribe to their shares at 100 rupees and still achieve a 50-50 sharing in the JV. Now, just because angel tax has been abolished, while the person putting 100 rupees may not create an income for the company, the person who's getting the same share for 1 rupee may still get caught under the mischief of another section under 56, which says that if you are getting shares at a discount, that discount is deemed to be your income. And I would again go back to what I started by saying, that if somebody is paying 100 rupees for a share, in my opinion, even if you take the fair valuation report at 1 rupee, there is a strong rebuttable presumption to be made that the real value is 100. The other person has subscribed at a discount of 99 only because they were supposed to provide services, and that entire service transaction has been guised, camouflaged in the issuance of share at 1 rupee, which can both become a risk under 56(2)(10 as well as under the GST provisions. So to just summarize, one, I don't believe there is any automatic withdrawal of the past litigation. In my view, the government will find it very difficult to give any such general instructions. And third, please bear in mind that just because 56(2)(7)B has been abolished, it is not an open one-way street to issue shares between parties at any price you want. There are various other provisions that can still catch the transaction, including under GST. Coming to the second question that the moderator asked in terms of the gross versus net in terms of TDS obligation under section 195, I think that question arises both in the context of purchase of property as well as in other common cases, which is purchase of shares. Again, for the benefit of the younger CAs, I think I just want to firstly highlight that because of the various amendments made in section 195, the obligation to deduct tax on payments to non-residents is now applicable to other non-residents also. There remains a myth that if there is one non-resident making a payment to another non-resident, the payer being a non-resident cannot be fastened with any obligation under section 195 because that will create an extraterritorial obligation, leaving aside some of the more fundamental principles of whether a tax law can go after a non-resident or not. But on the plain reading of the section, because of the amendments made, irrespective of whether the payer being a non-resident, irrespective of whether they have any place of business, irrespective of whether they have what is called a permanent establishment in India, they are still obligated to comply with the provisions of section 195. Now, unlike many of the TDS sections when it comes to payments to residents, where there is no reference to any chargeability under the Act, Section 195 uses the words sum chargeable to tax. 3 points to make here just to keep it brief. One is it only has a condition that the sum must be chargeable to tax. There is no requirement that there must be an actual payment of tax by the receiver. So for example, the receiver may say, I am going to make an investment under section 54, whichever limb, and therefore I am not going to actually pay tax, and hence the condition under 195 is not fulfilled. In my view, that is not a correct position. Second, it talks about the sum chargeable and not the income chargeable, and that leads to the main point which the moderator asked, that can the payer sit in judgment of what is the income comprised in the sum being paid, and can the payer take a suo motu call, of course perhaps based on a chartered accountant certificate, as to what proportion of the sum must I deduct the tax on, instead of deducting the tax on the gross amount. Of course, the section also leaves both the payer and the receiver the liberty to seek a specific application to be made to the department to verify what is the income comprised in the overall sum and give a specific order. But for various practical reasons, if that is not possible, we come back to this question of gross versus net. There the department themselves have issued an instruction. Of course, like most other instruction, that is not fully clear and free from doubt, but instruction 2 of 2014 allows the payer to deduct tax only on the income comprised in the sum, and to that extent, at least on share transactions, it is now a very common practice that based on a computation certified by a CA, only on the net income tax gains, the tax is deducted. In the case of property, while the principle should remain the same, as a matter of practical guidance, particularly when it comes to cost of improvement, because it is easy to verify the original cost, the stamp duty paid, those are all verifiable numbers. But since any seller is likely to also want to claim deductions for costs of improvement, which are always nebulous, my recommendation would be that either you seek an approval or a dispensation under 195 or ask the receiver to do it under 197 if that is relevant, applicable, or at least take some protections in case you are questioned later on. With this, I'll summarize my thoughts for now. Thank you.
With this, now we intend to enter the slog hours now, last few minutes. The question will be for Mr. Padam sir. Since I just saw a blog on the social media wherein a Mumbai Chartered Accountants has profusely praised his skill of interlinking various sections. So now I would like to link about 7 to 8 sections. 45.3 introduction of capital asset by a partner. 45.4 when the reconstitution of the firm takes place. Suppose there is a retirement, or somebody is admitted, or there is a profit sharing ratio, change in profit sharing ratio, and there is a repayment to the partner. That is 45.4. Next we come to 9B when the capital asset or stock in trade is given to a partner. 45.4 is the formula. A is equal to B plus C minus D. What is A is capital gain is equal to B. B is money plus C. C is nothing but the fair market value of the capital asset minus D. D is what? Capital standing to the credit of the partner on the date of the reconstitution. And then there is 50C and 50C. So I would like Padam sir to connect with all these 7 sections at one go. Thank you.
Multiple number of questions to be answered. Conceptually we'll deal with, that will be a better way of understanding than getting into all the transactions that Naveen has listed out. A partner introduces his capital asset into the firm. Supreme Court said, what was exclusively owned by the partner becomes a shared interest when it goes into the partnership firm. As a result of which, there is a transfer because exclusive interest becomes a shared interest. Case of Sunil Siddharth Bai's case, 156 ITR 509. But they said there is no consideration because they said the credit to the partner's capital account cannot be taken to be representing the consideration. Therefore, the computation fails because there is no mechanism of evaluating consideration. Therefore, they brought in 45.3 to say, I am going to feed in the value of consideration by saying the amount credited to the partner's capital account shall be deemed to be the consideration for the transfer of the asset into the partnership firm. That shall be the basis for you to compute the capital gains. So these type of sections like 45.3, 45(4), 46, 46 capital A, 50, 50B, 50C, 50CA, 50D are all sections that deal with some elements of computation of consideration for the purpose of arriving at capital gains. And therefore, we have in some situations concerned a clash, for example, between 45(3) and let us say 50C, when an immovable property is contributed by a partner into the partnership firm, or shares are contributed by a partner into a partnership firm, then 45(3) versus 50CA will come into the picture concerned. And in these circumstances, what shall prevail or what should prevail can be a logical and a natural question. One way of directly answering the question would be, if you go into 45(3), 45(3) is both a charging section as also a computation mechanism. It charges to tax the capital gains because of the transfer of the capital asset into the firm. It also lays down the value of the computation of the capital gains concerned. Therefore, it functions both as a charging mechanism as also a computation mechanism, whereas 50C is only dealing with a computation mechanism, does not deal with the capital, the transfer mechanism. As a result of which, therefore, when we look at the comprehensiveness in 45(3), we can make a statement that 45(3) should prevail over 50C. Somebody may ask me, this proposition may not be in tune with the Carlton Hotels case, Adalabad High Court case, but then that case was a case where the transaction itself was held to be a sham transaction, and therefore the principle of Carlton Hotels should not be applicable in normal situations concerned. And Carlton Hotels has been distinguished subsequently in a number of decisions, particularly Ishwar Das's case 203 ITD 250 is clear case of distinction of the Carlton Hotel saying that refers to the peculiar circumstances of the case cannot be extended to the case of an introduction of an asset for which 45(3) applies. And more importantly, when 50C was introduced, 45(3) is already there in the statute book, and legislature is presumed to be aware of 45(3), they still did not make a statement that 50C will apply despite the existence of 45(3), indicating that the Parliament has consciously chosen to say that between the clash of 45(3) and 50C or 50CA, it should be 45(3) that shall prevail. This is some sort of a summary in terms of introduction of a capital asset. When I take out a capital asset from the partnership firm, we may have a situation of a transfer because the asset is owned by the firm. The partner is not said to be owning any property. He has a specified interest into the generality of assets concerned. The assets are owned by the firm. When the asset is therefore moving away from the partnership firm into the hands of a partner, then there can be a transaction of a transfer between the partnership firm and the partner concerned. Logically, therefore, it should be taxable under 45(1) itself. When the firm transfers the asset to anybody, to any third party, as also to a partner, 45(1) can come into the picture. But if the transfer is in relation to, if it is in relation to a dissolution, if it is in relation to a reconstitution like a retirement, etc., then special provisions will come into picture. Therefore, there could be 9B of the Income Tax Act dealing with dissolution or reconstitution that can come in, or 45(4) that deals with retirement or reconstitution that can get attracted. Therefore, in those circumstances, the attempt is in a large number of cases to say, hey, I will transfer the asset to a partner concerned, I will make him retire the next year. Can I therefore avoid the application of 45(4) or 9B in those circumstances concerned? Interestingly, the law uses the word in relation to the dissolution or in relation to the retirement, not at the time of, in connection with. It's not at the time of retirement. Therefore, there need not be a transfer occasion on the date of retirement, on the date of dissolution. If you're able to link it to the event of retirement, to the event of dissolution, although the timing may be a little different, there's a possibility of 45(4) as also 9B being attracted. And the danger for us is that explanation 2 to 45(4) says when a particular asset is moving out because of an eventuality of a dissolution or a reconstitution, both 9B as also 45(4) can simultaneously apply. You may therefore suffer double taxation. You may possibly get some relief available under 48 subclause limb 3 when the asset is ultimately sold by the firm, which asset has been taken into account for the purpose of finding out the partner's interest and the partner was given away some other assets in terms of for his retirement from the firm concerned, the asset continuing to remain in the partnership firm. When it is subsequently sold, possibly the firm may have the relief under 48(3). That's something in the future. And therefore, to avoid double taxation, possibly everybody is worried in the hall today, how do I avoid double taxation when 45(4) as also 9(b) applies? Possibly one way of overcoming that mechanism would be to have a sale of an asset to a partner itself, such that you are definitive that 45(1) only should apply, 45(4) and 9(b) should not apply. But therefore, the conundrum, the problem for all of us is that there are multiple sections associated with the eventuality of retirement. Valuation mechanisms can be different, computation mechanisms can be different. In the hands of the receiving partner, there can be an additional implication of 56 to 10 being bothered about. 50D can come in where the consideration is not determinable or ascertainable. So in a large majority of situations, we are left grappling with multiple sections containing fictions in the statute concerned, dealing with particular aspects of capital gains, and we are called upon how to resolve this issue concerned. One thing, therefore, in my opinion, as a conclusion, and that's the way you could go forward, would be that 45(3) and 45(4) are to be regarded as special provisions because they are both a computation as also a charging mechanism, and therefore they should prevail over anything else to the contrary, be it 50B, be it 50C, be it 50CA also. That could be a proposition, and I think because of the case laws available to us, we may be able to draw adequate support to say that these special provisions of 45(3) and 45(4) should prevail over the generality of the provisions contained in 50C and 50CA. Thank you all very much.
So another slog over. So the question for our senior advocate now would be, now after post-September, you can expect a lot of searches under block assessment as well as survey. The concept of survey is now made a comeback now. So my question to our senior advocate would be on 3 lines. What if excess cash is found in your business premises or at home? Excess jewelry found at business premises, at home, as well as excess stock. Obviously, that would be found only at the business premises. As sir is going to take the mic, I also would recognize the presence of 2 other distinguished personalities on the dais. One is our past SIRC chairman, Pannaraj sir, who conducted that historic conference in the historic city of Hampi last year. More than 2,200 delegates, assembled there. And for the next 50 years also, I don't see anybody achieving that in that mega event. I also recognize the presence of my the amiable, affectionate and approachable Central Council member, Rekha Umash, Yeah. And now I also recognize, the presence of Dr. C.N. Manjunath, our Bangalore North MP, and who rendered distinguished service, 32 years of unblemished service to Jaydeva Hospital. Thank you very much, sir. Over to Shankar, sir.
The question posed to me as a slog over to hit a last ball 6 is difficult. I started as an opening batsman, took a single, moved on to the other end to give my 2 friends who blasted a few 6s and 4s for y'all. Now I come back to probably hit the winning run. Thank you, my friends, for giving this opportunity. The decision as to the manner in which an undisclosed cash, stock and jewelry are to be taxed has been one of the important aspects in all searches that I have handled in the last 25 years or 40 years. This is something very, very common that happens. Jewelry. How do you solve the problem of jewelry in a search case? How do you solve the problem of cash in a search case? And how do you solve the problem of stock in a search case? As rightly pointed out by the moderator, stock is a comparatively lesser issue because 99% of the stock is found in business premises, unless your business is jewelry, where you have taken the jewelry home to keep it as a stock. There are several jewelers that have been regularly searched, and some of them have the habit of keeping some of the stock at home. So we need to handle these things in an extraordinarily capable manner and advise clients as to the manner in which they have to give a statement at the time of search. This problem may not be in future a great extent because all of you are aware that the concept of search assessment underwent a lot of change from 61 till today. There was a period from 1961 to 95 when search was contemplated as a regular 148 assessment. From 95 to 2003, the block assessment came into picture. From 2003 to 2021, we had the 153 CA procedure. From 21 till the present budget, we had the back to the pre-95 procedure. Now we are back to 95 to 2003. The government has had 5 flip-flops on this for the last 70 years. Now, whether it is taxed as business income or under 115BE or under 113 in terms of block assessment in future is a very, very important debate. And if it is taxed under the block assessment, the rate of tax is 60% and under 115BE is also 60%. But under 115BE, you are probably liable to pay surcharge of 25%, whereas under the block assessment, to the best of my knowledge, I have not been able to find that surcharge is levied.
We request all the delegates to kindly assemble and be seated. We will be moving on with next session on our health, which is utmost important topic for all of us who are constantly under stress. We request all the delegates to kindly be seated.
CA Ranjit Kumar, Chairman of Puducherry branch, to present the memento to CA Abhishek Goenka. CA Harini, Chairperson, Salem branch, to present the memento to CA A. Shankar. CA Reema Sharma, Trivandrum branch, to present the memento to CA Naveen Khariwal. ನಮ್ಮೆಲ್ಲರ ನಲ್ಮೆಯ ಮತ್ತೊಬ್ಬ ಚಾರ್ಟರ್ಡ್ ಅಕೌಂಟೆಂಟ್
I request CA Ranjit Kumar, Chairman, Puducherry branch, to present a memento to CA Abhishek Goenka. CA Harini, Chairman, Salem branch, to give a memento to CA A. Shankar. CA Reema Sharma, Trivandrum branch, to present a memento to CA Naveen Khariwal. And also CA Reema Sharma to present a memento to CA Padamchand Khincha. It's been a wonderful technical session on contemporary issues in income tax.
ನಮ್ಮೆಲ್ಲರ ನಲ್ಮೆಯ ಮತ್ತೊಬ್ಬ ಚಾರ್ಟರ್ಡ್ ಅಕೌಂಟೆಂಟ್ CA ರಘುನಾಥರ್ ಅವರು ಇವತ್ತು ನಮ್ಮ ಜೊತೆಗಿದ್ದಾರೆ. ಇತ್ತೀಚೆಗಷ್ಟೇ ಅವರು ಚೆನ್ನೈನ ಇನ್ಕಮ್ ಟ್ಯಾಕ್ಸ್ ಅಪಲೇಟ್ ಟ್ರಿಬ್ಯುನಲ್ಗೆ ಮೆಂಬರ್ ಆಗಿ ಆಯ್ಕೆಯಾಗಿದ್ದಾರೆ. ಅವರನ್ನು ನಾನು ವೇದಿಕೆ ಮೇಲೆ ಕರೀತಾ ಇದ್ದೇನೆ. CA ಗೀತಾರ್ ಅವರು ಅವರನ್ನು ವೇದಿಕೆ ಮೇಲೆ ಕರೆತರಬೇಕು ಅಂತ ಕೇಳ್ಕೊತಾ ಇದ್ದೇನೆ. ವಿ ಹ್ಯಾವ್ CA SR Raghunatha, the member of Income Tax Appellate Tribunal, Chennai bench, is here with us today, is coming on the dais. Give him a big round of applause.
Ladies and gentlemen, after this session, we have a wonderful health-related talk by none other than Padma Shri Dr. Manjunath. We request all the delegates to be kindly seated. The famous cardiologist from Namma Bengaluru.
I request CA AB Geeta to felicitate Chartered Accountant SR Raghunatha. I request all the ex-members of
All
managing
the MC members to kindly come on to the dais, please.
ತುಮಕೂರಿನ ಒಂದು ಸಣ್ಣ ಹಳ್ಳಿಯಿಂದ ಕನ್ನಡ ಮೀಡಿಯಮ್ಮಿನ ಶಿಕ್ಷಣದಲ್ಲಿ ಓದಿ ಬೆಳೆದು ಇವತ್ತು ಆದಾಯ ತೆರಿಗೆಯ ಒಂದು ಉನ್ನತ ಹುದ್ದೆಯನ್ನು ಅಲಂಕರಿಸಿರುವಂತಹ ಸನ್ನದ್ದು ಲೆಕ್ಕಿಗ ಸಿ ಎ ರಘುನಾಥರವರಿಗೆ ನಮ್ಮೆಲ್ಲರ ಕಡೆಯಿಂದ ಒಂದು ಜೋರಾದ ಚಪ್ಪಾಳೆ. ಅವರಿಗೆ ಕೋತಾ ಶ್ರೀನಿವಾಸರವರು ಮೈಸೂರು ಪೇಟವನ್ನು ತೊಡಿಸಿ ಪನ್ನರಾಜರವರು ಹಾರವನ್ನು ಹಾಕ್ತಾ ಇದ್ದಾರೆ.
We value your immense contribution to the Income Tax Department. May your relation with the ICAI stand continuous in the future as well.
Dear delegates, we are moving on with the next session.